Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us today for our technical overview of the markets. Today we'll be taking a look at corn, soybean, wheat, and crude oil. But before we begin, we need to take a look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Once again, thank you for joining us for our grain market technical overview. We will have our first look at the December corn contract. And here what we will notice is that the market broke our trend line. And once the market broke the trend line post the USDA report last week, a very strong move to the downside shortly followed. The support level and minimum price target range that we were looking at was the 360 number. The market came down to that number, and as you can see right now, the market simply has been consolidating at that price range since then. We continue to be in a downtrend, so we're not looking for a trade to the upside in the market. If anything, we would simply sit on our hands as the market will either consolidate sideways, give us a minor pullback that should lead to another move to the downside. We're looking at a price objective of about 350 for the December corn contract. Until then, or until the market can give us indications of potential strength, we continue to be bearish on corn, especially given the information that we were able to see from the USDA report last week. Moving on to the March contract, what you'll notice here is a recommendation that we had released to our clients. You notice the market continues to be in a downtrend, and this chart has our swing analysis on it. On this swing analysis, you'll notice that our stop level came in at 393. Our projected entry area for our clients was somewhere in the neighborhood of 384 and a quarter to 382 half. So anywhere inside of that band was reasonable for an entry. And we had a minimum price objective of about 370 down to about the 366 and 3/4 area. Shortly after the USDA report, the market broke through, triggered our entry, and went straight to our target. But if it does not or is not able to hold its current price levels, we would project a downward move to about the 350 area or so for this March contract. We now fast forward to the new crop December contract for corn. And here in this chart, what you'll notice is we actually have a potential trade opportunity setting up. The reason we want to consider the trade opportunity for the new crop contract versus the December contract nearby is because of the time horizon before us with the ability to be able to capture returns without being shaken out of the markets. So as we look at the new crop contract, we would be looking at a stop level at 393, entry at 387, and a target at 373. Given those parameters, we're looking at a 2.3 to 1 reward to risk, and so this would be a trade that we would be interested in taking. In fact, where we see this green highlight here, the market is basically setting up for us a potential short opportunity. And the way we calculate this potential target is that we would anticipate that the move that the market makes coming into this actual consolidation, it would repeat it on the other side, which gives us this move down here. Our minimum price objective is at 373, but we could very well see a move that comes down to about 366. The January soybean contract seems to have found some legs here. And what you'll notice is the market is actually looking to put in a potential low inside of these areas. Our initial intent or our initial belief was that the market was probably going to be heading lower. And part of the reason for that is if you look at the most recent swing, we have our first leg down here for wave 1, a wave 2 here, a wave 3 low, a wave 4 pullback, and potentially a wave 5 low here. In addition to that, the market is actually giving us a bit of divergence. As you can see, the strength of the momentum from this previous wave 3 low in comparison to the current wave 5 low. Mind you, this wave 5 low is not necessarily complete, as the market could tick up just a little bit and then roll back down again. So this area here is potentially suspect. So we're not necessarily looking to take a long position here unless the market's able to come up and break these previous highs, which would then tell us that this trend is complete. So until we get back up to the 924 area, we continue to be bearish on the soybean contract. And we could very well just be looking at a consolidation for a few days that turns back down again. A different view of that same January soybean contract looks as follows. We had shown you before that this movement along the circle that the contract has formed was a potential low point or support point. The market came in and actually gave us a marginal break of this level here, but was actually not able to close below our circle. We had our wave 5 come in for a potential low here, and now that the market is actually has given us two higher highs or two buyers bars in this movement, we can now confirm this wave 5 in the movement itself and looking for potential resistance to come in somewhere near the 885 to 890 area or so. If that happens, we would then be looking for another leg down. And again, the market needs to break well above the 924 area before we can really say that a new trend to the upside is in place. Fast forward to the next upcoming contract, the November 2016. What we find here is that the market actually made a higher low in that same spot that the January contract actually made a lower low. So we're actually seeing a little bit of strength occurring for the March, or rather for the November 2016 contract. This strength here is going to be very important for us to keep a watch of. Because what this tells us is if the market is able to break the 917 level and then come back in and make our higher low, we now have grounds for a potential uptrend on the new crop contract. So this is going to be a very, very critical level for us here at the 917 level. If the market fails here, perhaps at the 893 level, and then drops back down, then we're looking at a new low that would be made in comparison to the previous low. But again, because of the nature of what's happening here, this contract is in fact in the midst of a crossroad. The next chart that continues to actually move quite well is the December wheat contract. Here on the December wheat contract, the market had met with recent resistance several times in the 525 half to 528 half area. The first time he met resistance was way back in mid-August. The next time was early October, and then finally just recently in early November. This most recent time when he met resistance, we suggested a potential sell opportunity coming into the market once we broke our regression trend channel. The market moved down quite nicely about midway to about 490, has given us a 3-day pullback, and we have since signaled a potential short opportunity at about the 489 3/4 area. We continue to believe that wheat will have continued weakness, especially by the looks of the stochastic turning back down and showing continued bearish indications for its movement. Right now, we're looking at a minimum price objective of about 465, which should give us a greater than 2-to-1 risk-reward ratio for this potential trade. There's quite a bit of supply. The strength in the US dollar is making it very difficult for wheat to be competitive overseas. And with those economic pressures surrounding this particular contract or grain, we do not foresee this contract being able to hold up in the near term. We'll continue to monitor and see how the contract travels or how it moves, but until economic indicators point otherwise, we'll continue to look for downward movement. Since the December wheat contract is coming off the board soon, it was only fitting that we take a look at the July wheat contract as well. You'll notice here a similar formation with regards to what the market has been trading. We recently broke out of the small consolidation zone that he had been trading in after making a big down move the previous 2 days into the consolidation. We now have a potential wave 3 in comparison to this proprietary count that we have. And what we're looking at here is for these market swings to potentially repeat and for the internals to give us an indication as to where these actual swings may terminate themselves. So here we're looking at a wave 3 looking to be confirmed. This wave 3 will not be confirmed until the price gets to 45.25. If it turns up from here, we're actually looking for a continued strength to the other side, and we would start a new count to the upside. By the way the market's looking right now, it's highly probable that we're going to get that confirmation. Upon getting that confirmation, we would then be looking at a minimum price objective of about 468 to 470 for the week contract before he could find a solid footing and then perhaps start to either go sideways and then look to trend up. In closing, we'd like to have a look at the December crude oil contract. We've been tracking the crude oil contract for quite some time. And as you'll notice here, some of the legs that we've been projecting have been coming to fruition quite well. The contract is currently sitting at potential support at about 40.89. But the ABC leg that we had been looking at is shaping out perfectly. We had a sub count inside of this leg down for this small ABC. The big A leg was confirmed. We got a swing to the upside for our B leg and then our final leg C here. Once we broke this A leg, we knew that the wave C was confirmed. It's now just an issue of where he wants to terminate. Now, as we sit in the current market right now, we're very close to previous lows that sat at about 38 or 39 or so. We have a price objective of about 35. So if we see continued weakness to the downside, we could very well see a consolidation that lasts near the 35 area before crude can finally get some legs and maybe look to turn to the upside. But in its initial approach to that 35 area, should it get there, we're probably going to see a churn or consolidation first. And once some accumulation starts to build in, then it may have some legs to turn to the upside, at which point we would roll over to the upcoming or the following contract as well. As we look at the markets, the overall picture continues to be bearish. We are sitting at key potential turn points with regards to support and resistance. We'll continue to monitor these levels for you. We appreciate you taking your time with us and look forward to being able to present our next market technical update.